Hey, Kevin, good morning. How are you doing? Last week of summer.
That's right. It's officially over, buddy. But that's okay for football junkies like us as we head toward the fall. You know, football season's on deck. I'm happy to get kicking that off. But hey, we had a great finish to the week last week. Thanks to the Jackson Hole comments out of Fed Chair Powell, we rallied pretty strongly. I imagine that that optimism heading into this week is pretty much setting the table for expectations for this week. Is that kind of the view you've got as well?
Kevin, I would think Chairman Powell set the table pretty darn good for this week. We'll see how it goes. But yeah, a couple of things to talk about. Looking forward to it.
Yeah, let's get down to business, everybody. Say hi in the chat today. We are joined by Michael Fairborn. You can say hey to him. He'll manage things for us. Questions that Mike and I are unable to get to live in the session here. Please feel free to post, though, for the session duration. We go about 45 minutes in total, and we'd love to hear from you. We'll certainly try to keep an eye on things. You can also take a minute and follow Mr. Fairborn and me on X, Mike Fairborn CS and Kevin Horner CS. It's a great way to engage with us after the outside of the segments that we host for you here on the channel. Let's get to our reminders for disclosures, and then we can move into the discussion for you briefly here, everybody. Remember that our conversation is only informational and educational. Remember, we do not make recommendations here nor endorsements for a specific approach to trading the market. So please keep that in mind. We will discuss technical analysis, which we do frequently in this segment. It's important, though, to remember that technical analysis is merely just a piece of the puzzle. We discourage you from making your decisions exclusively off technicals. So a combination of a multitude of factors make a lot of sense for decision making. So consider more than one viewpoint regardless when making those decisions, everybody. All right, we will remind you of our methodology for the show. We start broadly, so we're going to look at the biggest indices and then work our way into the groups, the sectors, industry groups that are moving around today, and then hit up perhaps some stocks in the news for you as well. So we always kick it off, Mike, with the S&P 500, but I got to say, you know, we may have been a little concerned last week about our opportunity to do what has been happening, and yet the follow-through on Friday, I think, is the reminder that traders try to stick with what's working until it no longer works, and they're waiting for some kind of confirmation that what was working is no longer working. Mike, it doesn't seem like we've had that just yet, have we?
Hi, Kevin. Welcome to the market, right? Unpredictable every day of the week. Unpredictable every day of the week. But listen, I think we got some promising news from the chairman on Friday, and I think that's the tone that I'd like to take on for the next couple of minutes. The market all year long, as you well know, has been, when are they going to lower interest rates?
Yeah.
Right? When are they going to do it, Kevin? Please tell me. I just want to know every day. And now you get Jay Powell, whether it was political pressure or not, well, to be determined. But right now, or after a weak jobs report a few weeks ago, right? And it looks like maybe inflation is taming down, according to the chairman. That's opening the door for a potential rate cut as we get into September. Now, the rally of 800 points on Friday, Kevin, I was happy for it. Jay Powell saying,
Sure.
Hey, indicating maybe interest rates are going to go down. Are they going down for the right reasons? His talk all year long has been, hey, whether it's tariffs or it's inflation, whichever way you want to call it, right? The topic of inflation was his main concern, and he wasn't as concerned about the job market. Now, he's finally, they twisted his arm. He's finally willing to lower interest rates. Maybe, we'll see, to be determined in a couple of weeks. But is it because the economy is slowing down? Is it because the job market is weakening? Are those things that are necessarily good for the market to be cheering on an 800-point rally, Kevin?
These are excellent questions to ask, Mike. Unfortunately, I'm not sure that we have the answers for these questions. I can tell you.
Well, I want you to think.
Well, I think that one thing we can take away, we can look at the rate cut probability factors and looking at the CME Fed tool. I'll remind you all, this is a third-party tool. This is not a definitive explanation by any stretch. This is merely the positioning of traders, if you will, in terms of expectations for the September cut. Mike, we're at about an 86% likelihood of a September cut according to positioning at this point, but we have seen this a little bit higher of late. As we were basing this on recent CPI, PPI data, that PPI number, for example, coming in hotter than expected. And when that happened, we saw this number spike over 90%. And then we've had in the last week here with Friday's conversation from the Fed chair is basically some semblance of confirmation. And yet, some traders may be taking a little bit off in prep of that, maybe buy the rumors, sell the news type thing. But we still have, 2-3 weeks before we hear from Fed officially. But this is how we're positioned, at least now. I really think, Mike, as we think about rate cuts, it's much less concerning or much less a conversation around September than it is between now and December's notification. And you'll see there's a pretty significant discrepancy here, Mike. This lower level, 350 to 375, that's a 75 basis point move. The implication there being 3 cuts, if you will, between now and the end of the year. So that's at about a 34% likelihood and a 48% likelihood at the moment for just a 50 basis point move between now and December. But Mike, we've seen this elevate a little bit of late, tied to Mr. Powell's commentary specifically.
Yeah, listen, I can barely see what's going to happen at the end of the day today, Kevin, let alone, in the middle of September, let alone December. If you and I, just for fun, wanted to kind of look at this from, I'll say, a year ago today, and we went backwards, you would see all different, targets for the Fed. And I think it always comes out every economic report, Kevin, this is the most important one, the one that's coming tomorrow, and the next one, and the next one. So again, we have the Fed's preferred one coming out later on this week. We have the personal consumption expenditures coming out on Friday. That seems to be, at least what they say, they're one that they're most concerned about. And I think when that number comes out, it affects all these probabilities that you see very quickly. So I've never seen odds move so fast unless I'm watching your Denver Broncos every day. But other than that, Kevin, I don't see the odds always moving. And I take it with a grain of salt. I use it as a guideline of what the market maybe is expecting. And I don't really go much further than that. That's the way I would kind of look at these things.
Well, I appreciate the comment because I agree. I think guideline makes a lot of sense. Let's not overdo things by looking at this. And again, remind ourselves this is how we're positioned, not guarantee in any way. These are just how traders are thinking. I think that's a helpful reminder. And I will let the Bronco comment go for the time being because people aren't here to hear about my love of the Denver Broncos. Let's move on to the NDX here, Mike. We had a little bit of a shift in what we've been monitoring in the NDX because we did break the 20-day. We did test some horizontal support in here around 22,000, 23,000, really, coincident with the 50-day moving average, Mike. There's that RSI playing out a little bit bearishly down below. We made a higher high in price, a lower high in RSI. And yet many traders, Mike, would tell you that perhaps we've already worked off potentially that bearish divergence through this brief pullback and horizontal support test. What are your thoughts about what we're watching in the NASDAQ here and what we need to pay attention to as it relates to the NASDAQ?
Listen, I think minus Friday, so forget Friday of last week, early last week, right, you had almost 4 consecutive days, I'll say 3 consecutive days, where the market was down, the NASDAQ was down. So since we're looking at the NASDAQ chart, right? So it pulled back, broke down below the 20. It didn't get quite close to the 50, which sometimes I kind of maybe like to see them test the 50 a little bit, just give it a little bit of a run for its money. But no, we didn't touch the 50. But listen, I think from a perspective of the market, obviously the NASDAQ's driven by the Magnificent Seven. I say that sarcastically, but yes, it is, those 7 stocks are really driving the NASDAQ right now. But at the end of the day, this is still a really strong uptrend. Whether I think it's a weak uptrend or not, you pulled back, you broke the 20. Do we always like breaking the 20? okay, it's not going to change the major direction of the trend. The long-term, short-term trend, yes, it changes it a little bit. But even the lows that we hit last week were still higher than that previous low in late July. So that uptrend for me still stays intact. Great recovery on Friday. Now the next step would be, if I'm a greedy guy myself, Kevin, when are we going to touch those all-time highs on the NASDAQ? Right? When are we going to get there? Right? Because otherwise, then the trend is kind of stalled. So maybe we work off a little consolidation period from the big move it made up from early, I'll say late April to early July, mid-July. We made a great move. So I think that working that off a little bit of a sideways pattern, a couple of weeks, maybe even a month or so. I don't know that that's the worst thing out there. When we start breaking that 50-day moving average, I think your second white line there at around 22,500, right around there, I'd be more concerned if we were breaking that low of the NASDAQ up there, a little higher. Yep. That would really probably be my concerning point for the NASDAQ. Other than that, the NASDAQ appears to be pretty healthy. Maybe some of the PE ratios are a little lofty on some of those stocks, but nothing that's causing me grave concern.
I like that assessment, and the thing that stood out to me about what you said, Mike, was the higher low. Yes, we broke the 20-day. We were below it for 2 days here, but we do have a hold move with Friday's closing above the high of the day we made our lowest low in this pullback. So many traders would tell you that Friday's action is the most significant of late. We haven't broke the downtrend line necessarily. Some traders would tell you that we need to do that for some semblance of confirmation, but ultimately, watching the trend, higher low versus this low, which was higher than this low, of course. And, again, I'll say it, matching lows are fine. It's the lower lows that get us a little bit uncomfortable. Now, the reminder that I want to offer here, everybody, is the little bit of a rotation we saw last week. We got some leadership with some of those lagger groups that we'll look at. We did see healthcare make a little bit of a move, which has been a group under a lot of pressure of late. There have been some minor changes in that regard from a policy standpoint, some holds on making significant changes that may have benefited healthcare a little bit. So the reminder I want to offer is that when we start moving money around, we take away from the leading groups. So tech was doing very well and semiconductors doing very well. We see these pull back to areas of support, and that money gets deployed to some of those lagger areas. So that's not a negative as it relates to broad market structure, essentially. Let's take a quick peek here, Mike. We'll move off of the NASDAQ. We're going to go into the Russell. I want to bring up a comment in the chat here. Just so happens to come from a good buddy of ours, Mr. Mark Item, reminding us there's always a big bad event looming. And I know he's stating that with a little bit of tongue-in-cheek, because ultimately I think what Mark's saying here is we tend to overdo. The narrative is reminding us, Mike, the number of key things that can't allow this market to go higher. And yet, Mike, we go higher. Don't step in front of the moving market, the trend of the market based on a narrative that's not playing out for us, right? The market will continue to confound the majority a lot of the time, if not 100% of the time, Mike. And I think the reminder is that caveats, or I should say idioms and axioms about the market, like a bull market climbing a wall of worry, those are reasons. There's reasons for those, Mike, historically. So keep those things in mind. Try not to step in front of a market that wants to go higher, seemingly in the face of the negativity that we've got. So, Mike, if you were listening to that narrative, that fear factor can override decision making. And we want to ignore that. We want to trade the real trends. And Mike, one of the biggest things I'm seeing play out here was not just a phenomenal move on Friday, but a break of what looks to be a pretty significant bull flag through an area of former resistance with Friday's action here on the small caps, Mike.
Hey, Kevin, I love your assessment of that, right? Listen, I think that the Russell 2000, right, that's what you have up there on the screen. I think, listen, if we believe the narrative that rates are going lower, if that's the narrative out there, if the narrative proves to be true, small cap stocks, which rely on research and development, reinvesting their money back into the firm, lower rates are going to help those companies. And we've been trying to see the I almost said the NASDAQ, the Russell, we've been trying to see the Russell break out numerous times. And so right now, what you just drew over there, your flag breakout, that's just of the last 2 or 3 months that we're seeing that breakout, right? If you go back on your chart and you look at some of the highs that we saw, give or take around Thanksgiving of last year, right? Now, all of a sudden, we're looking at a potential, this rally right now, if you could see that, right? Maybe we break out from the area that we did. And I kind of agree with you. We broke out of a tough little spot with a really strong rally on Friday. We need follow through. Whether the follow through is a light pullback today on lower volume or continued volume coming in on the and the Russell 2000 / IWM ETF. If we were looking at that, that gives you a spot where you might see a little bit of a rally. And what I'm seeing on your chart, even on my chart in the longer term, seeing a little bit of an inverse head and shoulders. Okay, you got the wrong title in there, Kevin. Inverse head and shoulders a little bit. So if you look at your highs from February and the high that we just kind of passed through over the last couple of days, gives us a little spot just where where you drew the downward flag, right? That gives us a little spot that maybe call that maybe an inverse head and shoulders, right? So, and if that's the case, there's a little bit of move. The way the pattern kind of works when we kind of break through that area, we take the low, which was down there at around 1750 on your chart, and we subtract that from that 2315 that you so nicely just labeled right there. So call it 1750 minus, or 2315 minus 1750, right? Give or take. It gives us about a 600-point differential right there. I'm not doing exact math, Kevin. But if that was the case, potentially, if the pattern could complete, gives us a nice little upside potential on that. Again, patterns are always a little touchy if they come to fruition, but I'm kind of liking the pattern I see right there. But again, if it fails to fulfill, the next thing I know, 2 minutes later, we're below the 20, below the 50, and below the 200, which we were, hovering over a week and a half ago, then I have a change of tune. But I think the market is optimistic for these stocks, given what Jay Powell said on Friday.
Yeah, I think that's the takeaway based on price action we received on Friday. We're not going to allow a little bit of red on the screen at the open of this week to kind of sour what we got. And I'll remind us that when we get significant moves through areas of resistance, that's the notable scenario, not necessarily the first opening trade following such a move. So let's we'll just kind of put a pin in it, so to speak, for the moment, as it relates to the Russell, because we are, we're just pulling or holding our level and pulling back a little off the open this morning. And one of the questions being offered up in the chat is about how we think the narrative of high value of the U.S. market could be playing into things. And I think this is a good reminder, Mike, that we traders need to kind of define what it is that we're trading on, right? Commonly, you'll hear the narrative. I'm just going to use Palantir as an example, just from a topical level. Palantir has been stated to be extremely overvalued based on a number of key factors. But if you're trading a trend in Palantir, Mike, you haven't had a reason to not stay on the long side much of late. Maybe today notwithstanding. But my point is that when you're trading the trend, valuations are irrelevant to the trend frequently. Valuations tend to be much longer term in nature, and they only rear their head when the current trend has broken commonly. That's when they start to take precedence, so to speak. So, Mike, when you think about the valuation of the overall market, are there key components that traders should be paying attention to, or maybe is it more important for them to just stick with the trend that's working and not concern yourself with maybe incorporating detail that may not matter to the current price action trend?
Kevin, I love the question. And we were throwing out, quotes before. The the trend is your friend until the bend at the end. So when the trend starts to break is when you just said, when we start to come in with these valuation questions, right? And how much what is an acceptable PE ratio for the market, Kevin, right? Is it 18? Is it 23? Is it numbers higher than 23? And we start to get nervous when those numbers start to kind of creep up. Kevin, where the market's trading at 25 PE, oh no, that must be overvalued, right? But maybe everything is humming, much like you said, right? Everything's going along. You know, the economy's moving. We don't have inflation. We have full employment. But the PE ratios are just elevated, right? And then it gives us a spot where, like, my gosh, Kevin, when's the market going to pull back? It's going too well. I'm making too much money in the market, Kevin, right? So I agree with you 100% on that, right? People kind of get caught up and they don't look at the valuations until all of a sudden, I'm just making it up, NVIDIA has earnings this week, which is a true sentence. We've got NVIDIA earnings later this week, not commenting on their earnings, but all of a sudden they have a bad earnings flat tire on Friday. Well, what did you think, Kevin? Look what the PE ratio was on NVIDIA. Of course it was going to come back in, right? So we have no idea, right? We don't know if NVIDIA is going to have good earnings or not, but you are correct. The PE ratio is acceptable until there's a bit of bad news. And then I Monday morning quarterback you and I say, hey, Kevin, by the way, why the hell did you buy that? I'm sorry, why the heck did you buy that anyway, Kevin? And why'd you buy it anyway when the PE ratio was so high? You should have known better.
Yep.
Right?
Yeah, it's. I think as Mark is reminding us here, is a great comment. Reminder that price to earnings ratio is backward looking versus price and trend, which is now. Which is what is happening at this moment. And it's one of the reasons that trend traders don't concern themselves with valuations, because it has much less impact on price, right? It only matters when it starts to matter, when traders see the significant shift. So I just thought that was an excellent question. I wanted to make sure we brought that to the table. I'm looking at the semiconductors here, Mike. We made that recent high, but ultimately, what I see developing here is much more of a consolidation in price over the last 3 months than anything else. What are some of the key levels you're watching on the semis? And I could add a little time here to make it a little easier for us. Let's go to maybe 2 years. Go ahead.
Well, Kevin, I think what we're looking at, I mean, the semiconductors are, a roller coaster, right? So, Yes, thank you. Thank you for drawing that line right there, because that's really the level that I'm looking at. Right? Can we break above that 59.10 area that you just kind of drew in there very nicely? And listen, when things look straight up, look at your 20-day moving average since the middle of since mid-April, and just the vertical climb that we did right there on the semiconductors, right? So I can remember a few months back, me and you were talking in early April, looked like they were falling off the cliff. Now they're rallying, trying to break out, to an all-time high. We pulled back a little bit. I'll be honest, if I were looking here at the stocks and, and I was listening to PE ratio, since we just talked about it, maybe I would look for a little bit of a sideways move. Not necessarily falling off of a cliff. The white line that you drew at 54.50, that could potentially be a pullback area, because what was previous resistance, those highs that you have, and it looks like October and, probably mid-January, those two highs right there, they should act as support if we pull back down. So 54.50, I'd be pretty comfortable with a support level down there. That is a break of your 50, but that's not a complete breakdown to the 200-day moving average. So we see some kind of support area there. The 5,900, we're going to have to probably, I don't know how much steam we could get. Maybe you get a little help from NVIDIA this week if they have a blowout earnings number, and maybe you start to see the chips kind of continue to rise. You had the government taking a little bit of a stake in Intel on Friday afternoon, a confirmed 10% stake. I don't know that that's really going to, Intel is necessarily going to move the stocks directly, but at the end of the day, there's some optimism for this sector. 5,900 might be a little bit of a touch just to kind of break out right at this minute. We're probably going to need another earnings cycle or another cycle of news to get those things above there right now.
I think that's an astute point. Obviously, you called it out. NVIDIA coming this week is going to be a major determination as to the next short-term move in the semiconductors. I added a little bit of range as a level here because I wanted to remind us of a couple of things. The first being that support is rarely a defined dollar or 1 point level. So let's give us a little bit of an opportunity to see some movement under the white line at 54.50. But additionally, this is a volatile space. You can absolutely anticipate intraday price action making its way down to a level and violating a level, but holding it on a closing basis, giving you something that resembles this excellent tail that we got last week, where we were below the 50 but closed back above it, giving you the impression that maybe sentiment shifted intraday. Those are significant developments, or rather they can be significant developments in the trend. So I wanted just to remind us, consider a range more so than a hard set level. But ultimately, if we were to close above 54.50 or so on any pullback, that would be considered likely a successful test of support. So validates watching that zone beneath us between 5,400 and 5,450 or so. We'll keep an eye on that for the semis. Now, in terms of sector action last week, Mike, I mentioned healthcare getting a bit of a boost last week. Now, we're breathing here a little bit, but you can see there's been a pretty good shift in healthcare finally. And yet, I say finally, okay, so we got out of the range we've traded in for the last 2 months, and yet we are still witnessing a pretty healthy downtrend, a 1 year long downtrend that remains in place. We are below the 200-day moving average. Let's not get ahead of ourselves in this sense. An improving group here, Mike, but we've not seen a breakout in the collective healthcare, though we have seen this in a few of the industry groups within it, notably biotechnology and pharmaceuticals doing a bit better than some of the broader areas of the sector.
Well, those guys are the horses of the sector, so hopefully that they will
Agreed.
do a little bit better. But listen, Kevin, I think after a decent size pullback. If you look at if you went to last October and you did a Fibonacci retracement all the way, for the bull move up to the highs, and then you look at the retracements, we're probably at almost a 75% retracement back of that gigantic
from the peak back here?
No, look at the lows on the left-hand side of your chart, the other lows. Do that from right there, go all the way up. Yeah, 78% move. I said about a 75% move back,
yeah,
right?
we did give back the majority of it, didn't we?
Right. So now I don't like moves like that, but I like the formation of April, May, June, July, and August, where we kind of put in a base, right? So you drew that support line really nice down there at about 1520, give or take right there. You had a nice little support base. Is this chart making me jump up and down? No, it's not. But is this chart giving me an idea that, hey, if I wanted to dip my feet into the healthcare sector a little bit, Kevin, am I going to get run over? I don't know that I'm going to get run over, but because it's put in a little bit of a base, and I kind of would be optimistic that 1519 would be kind of towards the floor, the lower level. Obviously, things can go lower. But right now, you're fighting the 200-day, which is declining. You're fighting that lower downtrend line, which you've clearly defined. So those are some of the things that make me concerned. But maybe, this is a spot where you start to dip your feet in a little bit if this was a sector that you were looking to get into. It doesn't look horrible, doesn't look great. It just kind of looks neutral right now. That's my take.
Okay, I understand where you're coming from. I think what you're speaking to when you said the low activity, or the activity in this 1525 zone that we drew in with my rectangle down here, what you were basically suggesting is that traders who are looking at that price action and noting the RSI improving, meaning we're making higher lows, even though lows in price are being tested at these exact same levels, kind of gives the traders the belief that, hey, maybe those lows are well established. And the implication could be that those lows are more likely to be held now than broken. And while it doesn't give us a trend shift necessarily, it can give bullish investors reasons perhaps to start to deploying new money to a space that has been beaten up a little bit. So ultimately what I hear you saying is investors longer haul, maybe not trend traders just yet, but investors who have been waiting to expose money may be more comfortable doing so by the way the price action has played out over the last 3 months. Is that ultimately the what you're suggesting perhaps?
Yeah, I think the longer term, more buy and hold investor can kind of maybe see a potential opening. A trend trader right now probably would need to see, all right, you broke out above your resistance at 1587, but you got upward resistance in the 200-day, so it's not really giving you much of a trade. I think a shorter term trader needs to see a break above that 200-day moving average for a short term trend to kind of come in. Maybe at least let's start with the 20-day crossing above the 50-day. We'll be a little happier with that. But I do think from a longer-term perspective, a long-term investor, maybe there's a bottom that it looks like we're trying to put in a floor. We didn't make the letter V, right? This is an elongated bottom down here. And again, I don't know that it's the bottom, but after a big move down, giving back 75% of what it made at the end of last year, this seems to be a spot where it's putting in a little bit of a floor.
One of the groups, like in addition to healthcare, and again, healthcare moving a little bit here, you would have expected perhaps Staples to get a little bit of a bid. We did get that middle of last week, but this is a group that's not doing what we thought it should be if you were looking for a defensive play. That's not playing out in Staples at this point. And it's showing its head a little bit in healthcare, but you're not getting as much of a defensive leadership, which I take to be optimistic for the view of the current trend, because if we had seen shifts in Staples already, that could be implying that money needs to be moving into defensives. We're not seeing it. I could also point out, Mike, that this energy space is kind of rangy in here. We've more or less been consolidating in a tighter range over the last few months. This stands out to me as well. But ultimately, Mike, I'm seeing still 1 day, 2 day basis movement from tech and consumer discretionary and communications, which have been our leaders, of course, really strong in this way. But the pullbacks in these groups are short lived and are just disseminating funds into those defensives, but very limited in scope. It seems as though our leadership remains the same groups: tech, communications, discretionary, and then two that not everybody's going to think about: financials and industrials, continuing to stay elevated and continuing to hold existing trends. Mike, any takeaways on those significant developments when we're looking at the trends here in these leaders and the defensives a little bit?
No, I think you're right. I mean, the one thing I would say, go back to the Staples for a second.
Sure.
And again, I'll say we're neutral to the sectors, man. We have no preferred sector or, hey, this sector should be going up. But I would be concerned myself that I was maybe missing something in the markets if the Staples were, I'm just making it up, 52-week highs.
Sure.
If the Staples were at 52-week highs, maybe I'm missing something, because the thesis that the Staples would be consumer staples, again, are things that we need to live every day of the week, Kevin, right? I need toothpaste. I need toilet paper. I need tissues. I need the basics of bread. Those kinds of things, if they were rallying and were breaking out above that, call it 925 area, I'd be a little concerned that the market is thinking that the economy is heading towards a recession. I'd be concerned that the market's thinking that interest rates are never going lower, and they might even be going higher, Kevin, while you're telling me 87% chance that they're going lower. Maybe they're going higher, and I'm missing something. So while all the other sectors, I appreciate what you showed me there, this would be the one that would be the most telling for me of what the Mr. Market is thinking. I'd be a little concerned if I saw this breaking out right now.
Okay, so the takeaway then is lack of breakout. Neutrality in the Staples can be optimism as it relates to the trend of the existing market, meaning more of the same, leadership from the same groups, and we've not seen any significant development from the defensives that would tell you otherwise.
Well, I hate to be boring, Kevin, but yeah. right? I mean, I hate to be boring, but yeah, that's kind of the case. And again, when we become complacent in the market is when we get hit with those whiplashes, right? It's all of a sudden, and if you look at the staples here, they haven't really moved at all. They have a really tight range pretty much since the middle of February. So they've been really tight. And I think that's just showing that the market is well aware that, any little thing could maybe set the market in a tailspin. So that I think people are holding on to their positions as a defensive spot. I don't know that they're adding to the positions. That's why the stocks aren't able to break out. And when I say the stocks, in particular, the staples that we're looking at right now, that's what I would say.
Yeah, I think that's a good takeaway. One area of note in terms of a significant movement today that we should look at, and this might be a little bit of maybe a heads up. We're going to look at crypto here with Bitcoin, specifically just the Bitcoin index, because we are seeing a shift. And it seems to be notable, Mike, because we've pulled back to an area that many traders would tell you needs to be held here in the short run. I'm going to move my line down a little bit to catch the low we just tested here. This is kind of standing out to many, Mike. We're off about 5,100, about 4.25%. But more importantly than anything, it's this ledge of support. We'd broken through it. We basically took the range, if I'm not mistaken. We basically traded from right in here up to the resistance, broke through. And I'd venture a guess, Mike, if I just measured the range here, that we made that exact same move to the upside already. So let's just see if I added it in. Yeah, so the measured move was achieved. Doesn't mean it has to hold, but it does mean that if it doesn't hold, Mike, we could see some volatility here in the price of Bitcoin over the coming days and weeks, perhaps.
Hey, just for fun, since you have that already drawn, draw it to the negative side.
Sure, why not? I'll bet it's similar to the 200-day moving average.
I bet darn well it is.
How about
that? Would be more that would be more concerning, right? So if you take away those two lines that you just drew, Kevin, you can see that we've broken the 200-day moving average. And if you look at to the left-hand side, go back to, I guess it's February this year, you can see that high again. That maybe had been slight previous resistance back in February, where those highs were. So it gives us a little bit of a zone that maybe if it were to break the 50, which it appears to be doing today, I'll use the Horner rule. Let's give it 3 days to get back above that 50. But if that's the case and it doesn't break the 50, then maybe I start to believe a little bit slight bearish scenario. And it doesn't mean I'm bearish. Slight bearish to the 200-day, because it's a pretty wide gap between the 50 and the 200. And if you look back in February when we did break it, we did the exact same thing. Now, it took a little bit while, but we went from the 50, huge gap, broke down below the 20, and we eventually found the 200-day moving average. Used it as great support, so I do appreciate that. This would make me, if I was a Bitcoin follower, I don't know that I'm nervous, but I would just say, hey, maybe just kind of have some risk management strategies on in case I don't want to take that ride from $111,000 down to almost $100,000, give or take about 11% move down, give or take.
That makes plenty of sense, Mike. Obviously, these attendees have heard me speak ad nauseum about management and understanding our own comfort and tolerance for risk. And again, I'll remind us that when we talk technical analysis, it doesn't tell us what's going to happen. It just allows us to set our risk properly and comfortably, hopefully. That's the takeaway of what technical analysis is designed to do. As it relates to Bitcoin, the last thing I'm going to mention is just the nature of Bitcoin is a risk-on view. So just bear that in mind. We had a nice move on Friday, a little bit of optimism, a little bit of dovishness from Fed Chair Powell led to that pop, perhaps, but it didn't break the recent sideways and consolidation action. So hopefully there's a level here for bulls that maintains. But if not, know how you're looking to proceed if things do shift through here, Mike, is the ultimate takeaway we want to give our viewers. There's some other things going on in the news. We did hear from Keurig Dr. Pepper, ready to buy JDE Peet's. So I believe that's Peet's Coffee, but let's pull up KDP and see a of our reaction here, off about 9% on the news, Mike. Not exactly an uncommon development as it relates to the company acquiring another company, right?
Yeah, I hear you. If you look at it, it's funny how it made, just if you looked at the chart pattern from the last couple of weeks, made a double top. It couldn't get to the top, and it fell right to the bottom of the range, and hopefully it uses that as support for that. Again, they just made a purchase of another company. They're going to separate them into two divisions, but
Yes,
that reads out that today's price action is a little below that support line that you just drew there, Kevin. So does get you a little concerned. Maybe the market doesn't like it as much as possible, but these mergers and acquisitions sometimes take years for the market to realize the true value of the deal. So, no, I'll be honest, I don't drink soda one way or the other, so I wouldn't really know. But at the end of the day, they're taking over one company. Market just seems, they're taking on a little bit of debt to buy that company, and that's usually how that happens. Why you see the pullback on the company that is doing the acquiring.
Yep. Very common. And some of these details, $18 billion deal. As you called out, Mike, they're looking at splitting the two companies up, essentially separating beverage from coffee. I'm sure there's plenty to go on that reasoning. But as long, hey, I don't, in terms of sitting at the price range here, none of this is impacting me individually unless they start reducing the price on Dr. Pepper, which I would be happy to see because, gosh, do I love a Dr. Pepper. Okay, moving off of that, let's look for some others in the news. We did hear, as you stated, we're going to hear from NVIDIA this week. We can take a quick peek here because NVIDIA did a pre-session pullback or pre-earnings pullback here, Mike, basically just kind of allowing the trend, as I see it, to breathe in here of late, Mike. So looking at this, lows have been in the vicinity of the 50-day. Really, NVIDIA has just been consolidating now for the better part of the last 6 weeks or so in advance of earnings. And the one thing I would look to was perhaps just a quick snapshot on the expectation of a move here is about 12 points with an IV, implied volatility, that's up a bit. It is elevated. So a $12 potential move one way or the other. It is going to be volatile this week, Mike, but nothing really different in the trend here, is there, other than the fact that we've broken that 20-day yet again in the most recent action here. Not negative on NVIDIA, at least from the trend currently.
No, it's not. I mean, it's interesting as you look at that RSI, the stocks, a week and a half ago is hitting all-time highs, and the RSI is dropping off. Never the relative strength, I'll call that divergence as the market's hitting a high a week and a half ago, and then all of a sudden the RSI is not hitting those same highs, does make me concerned and kind of follows through the chart pattern that we're kind of seeing right now. That 50-day is going to kind of loom pretty strong for NVIDIA this week if it needs it, down there at 167, almost the same 12 points that you just mentioned on the implied volatility a couple of seconds ago.
Mm-hmm. So, yeah, I mean, let's not get ahead of ourselves is maybe the reminder here when we're looking at NVIDIA. If you're playing it for earnings this week, you definitely want to lean into maybe risk-defined approaches, where there's more comfort to manage a pretty decent move. 12 points is maybe lesser volatility than what you may historically see with NVIDIA in terms of expectation of move. I think it falls in somewhere about around 8% of the maneuver or of the current price action, which we've seen NVIDIA's implied move be well higher than 8% historically. So, just as a bit of a heads up. The only other thing that popped out to me, we were talking about Keurig Dr. Pepper and Peet's Coffee, and I noted that there was a headline on Starbucks somewhere about, I think I saw Starbucks closing or cutting 2 weekly days of production. So Starbucks plants that are the roasters of their beans, it sounds like, are actually reducing the number of days in their workforce. So 2 days of their weekly production are being cut starting in January. These plants are located in Georgia, South Carolina, Pennsylvania, Nevada, and Washington State. They'll be adopting a 5-day schedule in lieu of the former 7-day schedule as Starbucks is looking to cut costs. And I'm a little surprised, Mike, because that's not a negative to the bottom line. You wouldn't expect. That is a shift to cost structure. Perhaps they're going to find some support, but the trend here is not beautiful, is it?
No, I mean, listen, Starbucks has been struggling for a little bit of time right now. So it's not, this is not new news. I don't know that I'm necessarily negative on Starbucks, but no, is the chart pattern look so great? It doesn't look so great right now. No, it does not. And we need to kind of hold that support line that you're drawing in right there, Kevin. It's never positive when the 20 is, turning down negatively below the 50. I'll be optimistic. It's a flat line on that 200-day moving average, acting as very clear resistance for the stock. So it's going to take a little bit of time for Starbucks to bust through that. Probably needs an earnings day or some kind of fundamental news to kind of probably push it through there. That's me being optimistic. But the same thing on the negative side as well, right? If you break down below there, next stop, on your chart right there is give or take around that $75 level where you kind of saw some support down there previously. So not overly optimistic on the chart pattern that you're showing me right there, Kevin.
I do have to agree, Mike. Unfortunately, we will wrap it up there as we are at time. But hopefully, Mike, we got to as many things as we could today. I know it was a wide-ranging conversation. Needless to say, I hope for you, love having you on. I really appreciate you being here, Mike. We will reconvene next month here when I bring you back. But thanks for being here, of course. Thanks to all of you for being here, everyone. Big thanks to Mike Fairborn there in the chat. You can follow us on X. Give us a thumbs up down below if you like the conversation today. We're going to get this one archived and into the YouTube channel for all viewers here shortly thereafter. But big thanks for participating and being here today, everybody. I hope you all have a fantastic Monday, a great rest of your week. We look forward to seeing you all again real soon.